Hey everybody, Steve here with IBC Global. Hope the day's off to a great start. In today's video, I want to answer a what if question that comes up quite a bit. And it actually came up yesterday when I was speaking with someone who has a number of policies, two policies, one policy on himself and one policy on his wife. And he's had them for a number of years. And he asked the question, well, what does it look like if I keep adding money to these policies? Which is interesting because when we first set his policies up, we had a very specific plan to fund the policies for 5 years and then stop. He had money in cash that he wanted to shift over to a high cash value life insurance policy for the core benefits being a safe, liquid, tax-free area to position funds. And the life insurance did provide some value to him as well. But what's interesting is as the years have passed, he's done well financially. He works for a large corporation. They work him hard. He's going nonstop all the time. He's at a stage in his life where he's thinking, you know what? I might go independent. I might go off and kind of do my own thing so I can do the things I really enjoy. And financially, he has the ability to do so. But as he looks at the policies, he does like the idea of using his policies for opportunities and such, real estate, business, whatever it might be. But he also likes the idea of continuously adding more money to the policy. So what if we have a plan where you want to fund a policy for a certain period of time, we'll say 5 years, because that's exactly what this individual wanted to do with his policy and his wife's policy, but then I want to fund longer. And let's say I want to continue to feed it at 50K per year, if that's the dollar amount I'm paying in, or it's a reduced amount, whatever it might be. What if I want to add more? Can I do that? And the same is true because the question comes from both sides of the fence, meaning one person might say, well, what if I want to add more? Can I continue to do so? I'd like to see that before starting a policy or after I've already started. Or what's it look like if I can't pay in the dollar amount I thought I could? Can I reduce funding? Can I bounce it up and down? The answer is yes, if the product is set up properly, if the company allows PUA adjustments and such. PUA is that cash dump in, I like to refer to it as. So let's get on into it and have some fun. What we're going to look at is first the original illustration, which is the original plan that the individual had. This is actually a policy on his wife. So his wife, when starting the policy, was the age of 44, and this was back in 2020. So this will be fun because we'll get to see what's happened over the past 3 years. He's in policy year 3 right now, but we can kind of track the performance, which is always fun to do. So age 44, year 1, we see age and year 45. 50K per year for 5 years and not a penny thereafter. Now, before I go any further on the columns here, what I want to hit on is of that $50,000, where is the money going? That is always the question to ask when it comes to maximizing the cash value of a whole life insurance policy and also the flexibility. I love the flexibility piece because I think of insurance, any type of insurance product, and my mind automatically goes to bill. I've got to pay this bill, this premium, this expense every year, and it's something I'd rather not have. However, with a whole life insurance policy, if it's set up correctly, well, I should say we can set it up in a manner where we have a premium, but then we also have other riders that can accelerate the cash value growth. So when we look at the specific design of this policy, where's the money going? So here's the premium piece, $5,000. Where we came up with that $5,000 is this insurance company will allow the minimum premium to be no less than 10% of the total payment. So premium dollars, this is a traditional whole life insurance policy, can be funded up until age 100. This is MassMutual's Whole Life Legacy 100 product. Since the 7702 update, if you're looking at a comparable product, it would be just the Whole Life 100. I'm not going to talk about different products today, otherwise I'll go off on a tangent. But to get back on track here, this is a traditional whole life insurance product. Most people that are presented whole life insurance are shown these types of products. I like to look at a variety of products, but this is a popular product. Now, the premium piece with a traditional product does not show up in cash value in the first year and the second year. So here's the important part to note about this. When he pays the $50,000 payment, each year into the policy. He funds it. What happens here? Year one, we scroll our eyes to the right, net cash value, what do you notice there? $43,000 in change. So I paid in 50. I don't have the full 50. That's financial pain. I took a hit. I've got less than what I paid in. Where's the money going? What takes the biggest bite out of that $50,000 payment is the base premium. So if we have a policy with a higher base premium, let's assume that he's paying the same $50,000 into this product, but the base premium is $10,000. Guess what that first year cash value will be? Be about $10,000, $5,000 less than what we see here, because the full 10K would not show up in cash value. Let's assume that that premium was $20,000. If that's the case, what would happen? Well, we'd see a cash value close to about $30,000 right off the bat. Additionally, that second part I mentioned about flexibility, what we are committed to is that minimum premium. So in a case like this, where we're going as low as we can with this particular insurance company, if life happens and he cannot or does not want to pay the full $50,000 for his wife's policy here, he's only committed to that. If he can't even pay that, the policy can easily pay for itself. I'm going to highlight where it's doing that in this example. But when the policy pays for itself, guess what it has to pay for? Just the premium piece. The higher the premium, if I'm not paying it and the policy is paying for it on its own, the higher the premium, the higher the drag, the expenses are. So a lot of details there as far as the initial design of the policy, because that's one of the most important parts. If you're starting a policy, the question is, how low can you go? Here's one of the major mutual companies, lets me go as low as 10%. Some companies a little bit lower, some not as aggressive, but just how low can you go? The premium piece will give, if the more you reduce that, the more cash value you'll have up front and long term, especially when you look at the guarantees and reality, actual performance, not just projections like we see here. But to continue on here, other pieces we've got LISR, which stands for Life Insurance Supplement Rider. This is term insurance that we added to the policy. It does not cost $5,000. Of that $5,000, a few $100s is directed toward the term insurance cost. So this 5K is actually broken up between term, and the rest goes to what is referred to as a PUA, stands for Paid Up Additions Rider. I like to refer to this as a cash dump-in. And then we've got at the bottom, ALIR, which stands for Additional Life Insurance Rider. This is another PUA rider that we are just shoveling into the policy. So first year, he pays in $50K. What does not show up in cash value is the premium, cost of term insurance, and then there's PUA fees associated with the product as well. Almost all companies have PUA fees associated with it. And we've got content that goes through the specific PUA fees, PUA limitations, all of that nerdy stuff if you're interested in that. But first year, pays in 50, 43,000 in cash value. Year two, he pays in 50. Cash value grows from 43 to 89. So here's a question I always like to ask. And where this question comes from is assuming that we flip positions. So pretend you're the agent recommending this policy for me, you're selling it to me, and I'm the consumer. What I would want to know as the consumer is year two, you pay in 50K. If you just stuffed this under your mattress, so let's assume yesterday you had $43,000 under your mattress, you add 50K to it, what would that grow to? Well, 43 plus 50 is $93,000. Yet the cash value here at the end of the second year is what? $89,000. We got less back than the 50K we paid in. The worst years of a whole life insurance policy are the first and second year. And the reason why is because that base premium does not show up in cash value. And again, I want to emphasize that this is with traditional whole life insurance products. There are some products that only overcharge for the premium in the first year, And there's some products that give us 80 to 90% of the premium in the first year. So it does depend on the product and company selection. But generally speaking, when we look at traditional whole life insurance products, I'll see that occur a lot of times. Now, as the years pass here, the next year we pay in 50K, cash value grows from 89 to 140. What's 89 plus 50? It'd be 139. So we got our 50K back and a little bit more on top of it. And each year it gets better and better. By year 5, I've paid in $250,000. And I have $250,000, 252. Now, this illustration was run in 2020, where the insurance company's dividend interest rate was 6.2%. And these cash value figures assume a 6.2% dividend rate is applied forever. In 2021 and 2020, the dividend rate has dropped to 6% flat. So I've got a lower dividend interest rate, which means the actual cash values will be lower than what I see here. So we're going to look at the actual values. He's in policy year 3 right now. He's paid 150K total into the policy. Now, his goal here was cash value. Before I look at the what if scenario we're going to look at here is look at that initial death benefit. What's important here, if you fall in the boat where you're thinking, hey, I'm interested in a whole life insurance product for the cash value benefit, I want to take loans against it, I want to use it for retirement, whatever it might be, and I don't really care about the death benefit, if you fall into that boat, where the death benefit's important is that will have a direct relationship to this guy, the bottom right-hand corner of the illustration, which right here is our MEC limit. So with a life insurance policy, what are the benefits? Safe, liquid, tax-free area to position money. Safe, liquid, tax-free. Tax-free if we do things correctly. Any life insurance policy can become classified as this MEC, modified endowment contract. If it does, the cash value will grow tax deferred, and anything I access, I'll have to pay ordinary income tax in the gains. If I'm under the age of 59 and a half, there could be a penalty. I don't want it. Let's put it that way. So how I prevent it is by not paying more money in than whatever my MEC limit is. And the fun part about this is we can set that MEC limit wherever we want. What it has a direct relationship to is, guess what? The death benefit on a life insurance policy. That is, call it the measuring stick that the IRS will use to determine if a life insurance policy is a life insurance in their eyes or a pure taxable investment. So when this was set up, the first thing we progressed through here was, okay, let's set the policy up to fund it for 5 years with a total of $250,000. That's what he wanted to pay into the policy. And this was back in 2020. And have had review calls with him over the years, and things have changed, and not necessarily changed right now, but his outlook has changed. And he said, okay, what's it look like? What if, Steve, I keep adding money to the policy? What does that look like? So anytime we're going to look at an adjustment, first off, I let him know we can do that with this policy. With his first policy, we could not with the way it was set up. This is why the design is important. But with this policy, what I like to look at is, okay, we can do that, Mr. and Mrs. Client, Mr. and Mrs. Client in this case. What I like to show is, A, what's it look like if you stick to the original plan? This way you've got that as a foundation, nice refresher too, to see how it's been performing. And then 2, the what if scenarios. What if you keep feeding the beast and pumping more money into the product that's compounding, and it'll average out between that 4 to 5% net growth rate, net internal rate of return when we look at it here. So here is what is referred to as an in-force illustration. So an in-force illustration will always display what your policy looks like moving forward based on the policy year you're in right now. So you'll notice on here, there's no years 1 and 2. Starts in year 3 because he's in year 3. Why the outlay here is blank and does not display $50,000 is because he's already paid that $50,000 into the policy. Payment's been made. When I look at the cash value, far right, 139 and change. The original projection displayed $140,000. Why it's slightly less here is mainly a result of the dividend reduction. That's the main thing here. As we scroll our eyes further to the right, death benefit's been appreciating. It's at $1.6 million in change. I'm going to pull up an Excel sheet shortly where we took these projections, put them on Excel, but we took the actual values that he received from his annual statements each year and exported them on Excel. So you get to see what it actually did in year one, year two, call it a live illustration as opposed to just projections, which I really like putting together. So again, this is the original plan. What I want to hit on here is a question that comes up frequently is what is this in red? This annual surrender, this $5,000 years 6 and 7. And if we go back to the original illustration, I saw that $5,000 years 6 through 10. Like what is it? So what this represents, this annual surrender, is look at the column immediately to the left or right of it. Let's look at the left. Annual outlay. This represents the client's actual payment, what they are actually paying in. The annual surrender matches this guy. Remember what this is? That's your premium piece that is due, but you're not paying it out of pocket. What's happening here is the policy is paying for itself through dividends and interest that are accruing on the policy, and it continues to accrue. So by year 5, still on track to break even. Beautiful. 250 in, 250 in cash value. Year 6, in this particular example, $5,000 premium comes due. He does not pay it, yet the net cash value still grows by about 10,000. So performing quite nicely. Now he can continue to pay into it. Question that sometimes comes up is, hey, how is the policy able to pay for itself here when I've got a dividend of $3,200? Like what's going on here? So life insurance illustrations are great when you really understand how they work and then just kind of think like, why do companies do it this way? Is here we've got an illustration with Mass Mutual. When we look at their 2020 dividend rate, if you were to Google search this, it'll be what? 6%. So naturally, I would think that the dividend column equates to 6%. However, why would it do that? And this is not anything against Mass Mutual. You'll see all insurance companies operate like this. Anytime we see the dividend column on a life insurance illustration, it reflects everything except for the guaranteed rate. So this product has a guaranteed rate. It's an older product that was issued before 2022. Guaranteed rate is 4%. So the dividend column reflects the surplus only, everything above the 4% between the guaranteed rate and the dividend interest rate you'll see when you do a Google search, which would be a 2% rate. They make it very, very simple to understand, right? No, I partly understand why they do that, and then part of me does not. But anyway, point is net cash value, that's your money column. That's how much it's growing by net each year. Where that breakdown of the guaranteed piece and surplus is good to be aware of is the question comes up, like the dividends not higher than the premium. So how on earth is it able to cover it when it's less? And I still get a $10,000 gain there. Like what's going on here, Steve? Well, it's how illustrations are put together. All right, let's keep going. What we did here in this example is after the 7th year, we executed or illustrated, I should say. We have not executed it yet because we actually have to do it in this year. What is referred to as a reduced paid up option. Do you see any premium column now? No. We eliminated it altogether. So even if he wants to continue to make payments after this point, he cannot do it. It's a great option to be aware of as it eliminates the premium altogether. I will see a boost to my internal rate of return and cash value performance. However, the drawback is I can't add more money. So before I ever execute this change, I want to be very, very certain that this is what I want to do, because if I don't want to do it and I do it, or I should say, if there's a chance that I want to add more money down the road, and I execute this reduced paid up option, I can't turn back. I would have to start a new policy to do that, which some people do as we weigh the different options and such, but I want to know that up front. So reduced paid up is exercised, cash value continues to grow. Now, to get back on track, what if I continue to add money to the policy? And his specific question was, well, what if I fund it for a total of 10 years? So my plan was to get a total of $250,000 into it. What if it's double? If I get 500,000 in, but I just keep adding 50 per year? Show me what it looks like if I fund it for another 5 years and then also for another 8 years. So a total of 13 years, the original 5 plus the additional, what if I go for another 8? That's where I come up with 13. So what we do is run projections to see exactly what that would look like. Here we go. Let me go back up here. So this will look familiar. If you rewind the video a little bit, you'll see by year 5, everything is spot on identical with the last example we just looked at, with one exception. Or I should say it's spot on identical through year 5, and then the one exception being every year after year 5, because we continue to make $50,000 per year payments here, which, by the way, if this is you, you don't have to continue to pay $50K per year. You can pay just the minimum premium. If you want to scale back on the payments, you've got a lot of leeway. So if you're in a position where you think, I funded it with X amount of dollars, but I want to keep going, what does that look like? Can I keep doing that? Show me the what if scenarios. That's the fun part about this. You can tell you're speaking to a true insurance nerd when someone says that. So here's what it looks like. He continues to pay money into it. And then we did the same thing with funding it for 13 years. So exact same thing here, just another in-force illustration, and see what it looks like as the years pass. So we can go back and compare and contrast, or we can have some fun here and look at it side by side. So what do we have first? On the left, we've got the original plan and what has actually happened. So years 1 and 2, let me actually scroll to the left so we get the years. There we go. Years 1 and 2, that was 2020 and 2021, $50,000 payments. That was actually made. And then actually he's in year 3 right now. This is for his wife's policy. That's why it's age 44 female. He's already made that payment. And then here's the in-force illustration value by year 3. Quick side note, when you look at illustrations, whether it's a new illustration, in-force illustration, if you're looking at projections, they are accurate year to year. Every year, we do want to look at a new in-force illustration to get a fresh projection on the values. Illustrations are also accurate, assuming that all payments you make are made on your policy anniversary date or within the 30-day grace period. If I've got a policy where I can add PUAs at discretion, PUA payments begin to receive any dividend credits based on the date they are added. So my illustration might show $100,000 at the end of the year, assuming I paid my full premium up front. But if I pay the minimum up front and then sporadically add more money over the course of the year, I might have seen a projection that showed 100, but my actual value is 99. If that part made sense. Let's continue on here. So he's paid this in already. There's his projected value. And this matches the in-force illustration we just looked at. Here was his original plan, stopping after 5 years, 250 grand in the policy. Now, he keeps going. What do things look like? Let's continue on here. If he continues to fund through year 10, what do things look like? Let's have some fun here. Everything's identical through the 3rd year. In fact, it's identical through the 5th year. But now I keep on feeding the beast. Through 2029, policy year 10, and there's the cash value growth. Looks good. If he decides to continue to fund money into the policy, what do things look like? Well, there I go. Fund through year 13 here. And it can continue to go longer. How long can he pay into this policy? Up until age 100. The PUA riders, one of the PUA riders, that ALIR rider with this particular company and product, is payable till age 90. So he can pay into it for a long time. Has been MEC tested, so we don't have to worry about a MEC or any surprises occurring down the road. But that's if he wants to pay into it that long. It's nice when you can adjust as you go. That's the fun part. What if I want to adjust my payments as the years pass, what does it look like if I fund it for 5 years, 10 years, 13 years? We've looked at a lot of what if scenarios with him over the years, him and his wife, that is. Specifically, what's it look like if I take a loan and pay it back, don't pay it back, or pay just the interest? What's it look like if I take income starting at age 62, 65, 67, when I start my Social Security benefits? That's the kind of stuff that people like to see, different what if scenarios. And I'll always throw in my 2 cents from a recommendation standpoint, but at the same time, if you want to see X, Y, and Z, I think it's important to show X, Y, and Z. I mean, I like when I work with someone and they show me what I request and don't try and talk themselves out of a situation where they have to do more work. I only say that because we've seen that occur. I have, at least when I've worked for different companies and such. Anyway, let me continue on. So point here is, what if you want to continue to add more money into the policy? Can you do it? The answer is 100% yes. And the dollar amount can adjust along with the funding period. Completely up to you. Everything's in your control, which is really nice. It is important, I'll close with this. It is important to design the policy properly to accommodate that. 1, from a MEC testing standpoint, 2, just from PUA riders, and then 3, with a PUA flexibility. I stumble over my words there. What I mean when I say PUA flexibility is, if you take Mass Mutual here, one of the big 4 that I'm a fan of, their PUA flexibility with their lister rider allows for adjustments to occur 1 time per year, every year when your premiums due, without any medical underwriting. So he's in a position, and he's been in a position, where the 1 time per year payment hasn't been a problem. He says, okay, I've got the funds liquid. I just want to throw it in and be done with it. I'll use it if I need it, but that's what he's been doing. If he said, hey, can I commit just to the 5K and then throw more funds in at my discretion? Mass Mutual is not a company that will allow that, not yet at least. So that's where we look at a Guardian or something like that. However, you've got some other restrictions. So that's just where company selection comes into play when we're looking at PUA flexibility. All companies have different rules there. But in any event, hope you enjoyed this video. I had a lot of fun with it. It's always good to go over the what if scenarios because they come up quite a bit. We can never predict the future. Be nice if we could, but we cannot. If you enjoyed this video, please hit the like button, subscribe for more. And if you have questions, please leave them in the comments below. I do look at those. If you'd like to see any specific case studies, what you liked about this video, what you did not like about it, and we will answer your questions and create more appropriate videos. Have a great day, and thanks so much for watching. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.